Debt is a double-edged sword in the realm of finance, splitting into two personas: the villainous bad debt and the heroic good debt. Picture this: bad debt, the cunning antagonist, emerges when you owe money tied to assets that lose value, like a car devaluing with every mile. It shackles you with fixed payments and dwindling worth, a financial quagmire. Welcome to the channel, subscribe and let's dive in. On the other side, enter good debt, our valiant protagonist. It's a strategic alliance, where borrowing begets assets on the rise, investments that escalate in value or generate a cash surplus surpassing debt payments and expenses. It's a debt that pays you, enhancing your financial stature. Yet, every debt adventure carries risks, a thrilling journey where you might reap rewards or face the dragon's wrath. Choosing your debt allies wisely is paramount. For in this financial odyssey, some debts are your faithful steed, propelling you forward, while others are mere anchors, pulling you down. Stay tuned as we unravel the saga of good and bad debt, guiding you through this intricate financial landscape, where decisions carve the path to financial triumph or turmoil. Are you ready to delve into this financial epic? How does debt make you rich? Debt, the financial magic wand, can wield extraordinary power when wielded wisely. It's not just about what you owe, it's about what you can achieve. Imagine this: good debt, a financial superhero, lets you borrow to control assets that appreciate and generate cash flow, enriching your net worth. It's leverage in action. With a modest monthly fee, you control assets worth multiple times the payment. Your gain isn't the payment, but a piece of the valuable asset. Businesses, too, are born from loans, granting entrepreneurs the essential capital to kickstart and operate. While the banker owns the interest, the visionary owner commands the business and its future prosperity. Debt is the gateway to creating valuable assets, a tool for everyone to embrace their inner capitalist. Are you ready to wield the power of debt for financial prosperity? 5 powerful ways to use debt to build wealth. Leverage in real estate. Real estate, the realm of financial multiplication. With just a 5% down payment or even less, you can command properties 20 times your capital's might. For a mere $10,000 down payment, you're at the helm of a $200,000 house, steering a ship of potential returns. Real estate investors dance to a unique tune. Their returns pirouette on the grand stage of the full loan amount, not just the initial investment. When the property's value pirouettes by 20%, that $10,000 down payment ignites a spectacular 300% return. But that's not all. Debt waltzes into the world of monthly rental properties and Airbnb ventures. Every monthly payment fuels a cash flow, a river of income, leveraging the total debt for impressive returns. Are you ready to let debt conduct this symphony of financial success in the grand theater of real estate? Leveraged buyout. Picture this: a financial adventure called a leveraged buyout, LBO. It's like a strategic chess move in the business world. The buyer, or a group of them, takes center stage, fueled by ambition and vision. But here's the twist: they don't march in with empty pockets. Oh no, they wield debt as their sword. It's a daring gamble, where the assets of the company being acquired become both the battlefield and the prize. With the acquired company's assets as collateral, they boldly storm the gates of ownership, seizing control. Yet, the debt doesn't weigh them down. It's more like the wind beneath their wings. Their plan is a financial ballet, a graceful choreography of debt repayment with the future cash flow of the acquired company. The debt, once seemingly ominous, transforms into a stepping stone toward ownership and prosperity. In the grand finale, the buyer emerges triumphant, brandishing the scepter of controlling interest. It's a financial epic, where strategy and debt unite to script the story of acquisition and growth. Short selling. Imagine this financial acrobatics act: selling short. It's the reverse of the usual stock tango, where you start by selling something you don't even own. It's a daring financial dance where you borrow from your broker and then sell to a buyer, leaving you in debt for the shares you owe. Picture this: you're at the stock bazaar, and you spot a hot cake stock that you believe is about to tumble. You swiftly borrow it from your broker, promising to return it later. With these borrowed shares, you take center stage and perform the sale to an eager buyer, raking in cash. But remember, you're playing with borrowed toys. You, the broker, those shares. Now, you are holding cash, but you're in debt for the shares you borrowed. This makes you both a cash holder and a stock debtor in this financial theater. Now comes the twist in this financial thriller: the buyback. When the stock price plummets as you predicted, you swoop back in. You use that cash you held to buy the shares at the new, lower price. These shares go back to the lender, your broker, fulfilling your debt. In this grand financial ballet, the profit pirouette happens if you sell short at a higher price than what you buy back for. This difference is your profit, earned using borrowed shares and a bit of financial foresight. But wait, there's a ticket to this show: margin interest. While you're in this short position, you'll need to pay a fee for borrowing those shares, adding a note of caution to your financial dance. Here's the magic: you can make money in both up and down markets. It's not just about stocks soaring high. It's about mastering the art of profit, regardless of the market direction. Sell short, and you've got a whole new angle to play in the stock market game. Margin account. Welcome to the financial fast lane, the margin account. It's like a turbo boost for traders, where brokers lend you cash or shares, using your account as a golden ticket. With this ticket, you can buy more, trade more, and potentially win big. Picture this: you want to trade, and the regular account size just won't cut it. That's where margin trading strikes in, adding buying power to your account. It's like leveling up in the stock market game. More power, more trades, faster action. Now, here's the magic trick: leverage. With margin, you can double down on your trades. If you trade 100 shares, the margin lets you trade 200. Wins are amplified, and so are losses. So tread carefully on this high-speed track. But why the excitement? Well, margin is your VIP pass to a swift trading ride. It's the secret to maintaining your buying power, even when your trades are still doing their makeup backstage. Caution is the spotlight in this dazzling performance. While margin offers a chance to dance with the stars, it's not without risks. Just like a thrilling roller coaster, it's an exhilarating ride, but one that requires skill and a safety harness. Using debt for living expenses. Picture this: strategic finance choreography. Investors are dancing through the tax maze, pulling off moves to minimize the tax spotlight. Imagine tapping into debt strategically, like a well-rehearsed routine, to pay living expenses without inviting the taxman to the show. One slick move: margin loans against portfolio holdings. It's like borrowing from the future without selling today's stars, avoiding capital gains tax. High net worth individuals master a bigger routine, using lines of credit backed by assets strategically. They pay off loans using tax-friendly sources, such as selling losing investments or dividends. Each move carefully crafted for optimal tax performance. In this financial ballet, the stage is set to keep what's rightfully theirs and ensure tax hurdles don't steal the limelight. Bravo, tax-savvy investors, bravo! Thank you for watching. Follow for more.